Hey, it's Tom Sheeran with Brookshire Hathaway Realty in Real Life Real Estate segment today. We're going to check in again about more changes in the mortgage industry. Hey, happy Friday, everybody. Tom Sheeran. We're with Maritza Chiaway again from Prosperity Mortgage. We are now into 40 some days on the lockdown, stay at home. We're at 24th of April today. So we want to just kind of recap. And of course, there's been ongoing changes as well. So Maritza is going to bring us up to speed on the CARES Act, what's going on with rates currently. We've got more strict requirements happening and covering, also we'll be covering about payments and the new buzzword of the de-risking of loan products too. So Maritza, what can you tell us?
Hey everyone, Maritza Chiaway here from sunny Florida. I'm a mortgage consultant for Prosperity Home Mortgage. So today I wanted to talk about, like you said, Tom, what the heck is going on in the mortgage market. I'm going to share my screen. Oh, I think I'm unable to share my screen, but I been seeing a lot of questions on what has happened. And it has happened a lot, and sometimes we forget and we kind of lose track with all this media information. But basically, COVID-19 is the most devastating pandemic in modern history, has created unfortunate economic and severe consequences. Isolation, social distances are causing business to shut down, lay off non-essential workers, job losses, 26 million as of April 23rd. It has eliminated all job gains since the 2008 financial crisis. The CARES Act gives the borrower an open invitation to skip mortgages payments, called forbearance, up to 360 days without demonstrating a financial need to do so. So before, when you wanted to get a loan, actually until today, you still need to provide documentation regarding your income, your assets, and your employment history. Today, to get out of the loan or to have a forbearance agreement, let's put it that way, you don't need to prove your financial hardship. That it's considered to be a little dangerous. It could deplete your equity. So my word of advice is use it only if you really need it. We will touch base on that later. Federal Reserve, just as it did in the crisis before, is now buying large amounts of treasury bonds and mortgage-backed securities in an effort to enhance liquidity in the market. Okay, so what they're trying to do is lower even further the interest rates. And now what lenders are facing is that we're having a lot of inquiries because there's a little bit more liquidity, but we can still keep up with the demand, especially for refinances. I'm going to touch a little bit more on that later, but basically the consequences, the job losses have raised the likelihood of future increased forbearance requests and mortgage delinquencies. Loan servicers, this is the deal. So when someone stops making payments on their mortgage, the servicers have to make the payments for them. And that brings liquidity down. So that's when the government comes in and brings the liquidity back to the banks, okay? As of today, we have 3.4 million borrowers in forbearance. Massive increase of refinancing activity has blown up investors' prepayment expectations when valuing a mortgage. So that's another disruption that we have. When someone refinances their home, the investor that holds that mortgage is counting on a 30-year timeline to receive interest. When you refinance, the investor knows that that's not going to happen anymore. So how are you going to price that loan in the market? It's another disruption that the market has.
So let me jump
All
in
this,
1 second. So
yeah,
3.4 million borrowers, that is crazy. It, so a lot of that's disrupting the whole market. As you said, the initial lenders, you know, are going to be very hesitant. The investors or the buyers of the loans are not now knowing all this. So it kind of brings things to a screeching halt, or at least treading with a lot of caution, right, on all ends of the loan process.
absolutely. This is what we were talking about earlier, Tom. So if I am, as a lender, I have to make those payments, and it seems that that amount of payments that I'm going to make is not going to stop today. It's going to, the forbearance agreements are going to keep increasing, right? So I have to make those payments, but I also have to lend money as a lender. So that brings a lot of disruption in the market. And we had to be efficient on the use of those funds, because when I lend money, I want to make sure that the money I lend is for someone that has a stable income and has a credit score of at least 660, and I know it's going to be a good loan that I can sell to my investors afterwards. Because I have liquidity crunch. I don't have that much money to lend, and I had to make sure that my next business arrangement with my next borrower has to be efficient.
Mm-hmm.
So all these factors are pushing down the value of the mortgage, of any mortgage basically, which is keeping mortgage rates going even lower to help the market. Lenders in general, we are de-risking. So what that means is that our portfolio, okay, which is basically the 95% of the products that we used to do before coronavirus, we're still doing them, okay? But that 5% that is basically focused on self-employed borrowers, where we wouldn't check any tax returns, we wouldn't review any business tax returns, we only review bank statements, or a foreign national borrower comes, let's say, to Florida, wants to buy a second home, we'll base our criteria on their tax returns overseas. Credit scores at 580, believe it or not, we used to do those. Those we have suspended temporarily. That's only 5% of our portfolio. The other 95%, we're still doing. We're still open for business. We just try to focus our liquidity into these loans, which are readily sellable right after closing. And that is a stable business for your customers. Pricing has been extremely erratic for weeks now, although at Prosperity, things seem to be settling down. Liquidity is increasing, and our pricing is a lot more stable than our competitors.
And I think when we know this is all temporary, and as quick as lenders has had to make these changes, when the market's back to somewhat normal, we'll see some lessening of the restrictions as well, right? So
Right.
that could be another few months away, but so this is all good news, but we just have to see what happens with people's jobs, and they might do a temporary forbearance, then be ready to take it back. So that'll help clear up. But yeah, for right now, this is what's happening, right? And
This is what's happening right now, and it's all because of the circumstances and liquidity crunch that we have. That doesn't mean that it's going to stay like this for the rest of the year. Okay. By example, A couple of weeks ago, our down payment assistance program, which is a financial assistance program for borrowers that have very little down payment or closing costs saved, um, that program has been out of the market already for 3 or 4 weeks. Okay.
Mhm.
Now, there's still talks on when this program is going to come back to the market. Okay. Um, the housing authorities are knocking on lenders' doors, asking for business where they can put that money. Now, it can't be put in any loan. It has to be a loan that has the appropriate risk to the lender. Okay, so definitely liquidity is coming in the market. It's just going to be very slow, but we're going to see the changes in the next few months.
Mhm. Yeah.
Another
So,
thing, oh, go ahead, sorry.
and again, just back at the limits. Prosperity is at 660 currently, and we know many other companies are requiring 680, 700, um, as far as FICO scores. But and the creative stuff is just everything's on hold, which makes sense with people out of work and um, down payment assistance and score requirements. So we'll see it all get better. But again, today, this is what's happening.
That's what's happening today. It's because we want to make sure as a lender that we have the financial solidity to be able to keep lending money and to keep putting liquidity in the housing market. Um, there are other lenders out there that you will see and you will hear in the market that they're still lending at 620, they're still lending at 640, okay? That doesn't mean we're going to do that, all right? We want to make sure that we're still here for the long run, and not just being a small lender shop where it's not going to be around in the long term. Okay. There's a lot of disruptions in the market. It's still on the mortgage rate. There is this expectation that the mortgage rate should be even lower. Okay. That is not reflected in the market yet. And the reason why is because we still have a spread between the 30-year fixed rate mortgage and the mortgage bond yields. During the last 8 years, that spread has been really, really stable at 1%. Okay. But since coronavirus, you can see the drastic reduction in the value of the mortgages due to servicing issues, forbearances, delinquency, and increased prepayment. So you'll see that the spread is as high as it could be. And even if the liquidity is improving, that spread is going to still be there. So that's why you don't see lower interest rates in the market. Mm-hmm. People think they should be, but there's a lot of disruption nowadays and they can't be any lower. Okay. So that's what's happening with mortgage rates.
Okay, good. So again, it's temporary, but a little tighter restrictions. We're still around. We're still doing business, and again, everybody just needs to kind of just hang in there. It will get better. It slowly is, and these are smart measures to just keep everything solid and in place. And we'll check in again next week with Maritza from Prosperity Mortgage, and we appreciate your update today, and thank you so much.
Thank you, Tom, for having me here one more time. And if there's any questions regarding the market, please feel free to reach Tom. Has incredible knowledge on the housing prices and the real estate in the Georgia area. And I am a mortgage consultant for Prosperity that can answer any questions that you may have.
Excellent. Thanks, Marissa.